Welcome back. Now, the capital goods sector saw a record run in FY24. But does the sector have the power to rally further? Vamakshi joins in with the key expectations for Q1 FY25. Vamakshi.
FY24 was a blockbuster year for most product companies in the industrial space. It was characterized by record high order books, strong government-led domestic capex momentum, which offset the slowdown in exports and margin surprises. In the first quarter of this financial year, the top-line visibility across segments is very strong. Revenue is expected to grow in double digits, driven by execution of orders received in the last couple of quarters. While operational efficiency, favorable mix and better pricing could support margins, though a rise in commodity prices could place spoilsport. Nevertheless, margins are expected to expand on a YOY basis. Companies may continue to benefit from a strong inquiry pipeline, especially in T&D, data centers, EV, railways, amongst others. However, order inflows may see some moderation given the elections, which is largely expected. For ABB, process automation and electrification segments are expected to drive growth. Order backlog of nearly 8,900 crores will support revenue growth of nearly 23%. With the base quarter EBITDA margin at 13.9%, we anticipate an expansion of nearly 330 basis points, resulting in a 46% uptick in the net profit. For Siemens, the company could see its revenue rise by 19% on account of healthy growth in smart infra and mobility segments. Margins may expand by 240 basis points to 14%, but UBS believes that the company has the potential to deliver a surprise. Clarity on HVDC orders in energy segment and large tenders in mobility remains critical for this company. CG Power seems well placed to capitalize on continued capex-driven demand from industrial and power segments. We expect the company's top line to grow by 20%, margins to remain more or less flat, down 10 basis points. But Nuvama believes that the company's margins may remain weak for the next 1 to 2 quarters. We will also be watching out for clarity on exports ramp up with expanded capacities nearing completion. As far as BHEL is concerned, Bank of America expects strong order inflow of 30,000 crores this quarter. We anticipate a 13% growth in the top line and 380 basis points improvement in its margins. In fact, Bank of America expects EBITDA break-even from this quarter itself if execution momentum sustains. As far as Cummins is concerned, revenue growth of 10% is expected to be driven by robust domestic demand, but exports may remain weak given slower recovery in end markets. With rising share of CB/CP4 gensets, margins are expected to rise by 360 basis points on a YOY basis. Apart from that, management commentary around demand outlook, transition to the new norms, and any competition-led margin pressures is critical to monitor. It is also important to see whether margin surprises, as seen in the past few quarters, is able to sustain. Most of these capital good players have seen continuous upgrades on account of the pickup in ordering activity, growth in the top line and profitability, which has driven a re-rating in the sector. Valuations, as you can see, for most players are above the 5-year average. Nevertheless, UBS has maintained its positive view despite expensive headline valuations. Additionally, Nuvama believes these premium valuations are warranted given the capex super cycle.
Okay, all right, premium and how? 100 times. Who would have thought we will live in an era when we see those kind of earnings multiples for capital goods players? Vamakshi, thank you very much for that backdrop. Much appreciated over there. We have Harshit Kapadia from Elara Capital now joining in to take this discussion forward. Harshit, great to have you on. That's really the question, right? I never thought in my career I'm going to see 97 times or 100 times for a capital goods stock, right? But here we are having this conversation. So you tell us, from an earnings standpoint, what is the run rate that these companies will have to keep throwing up to justify these numbers? And do you think we will have evidence of that kind of growth in this quarter?
Yeah, morning. So to have a justification of such a high valuation, we expect an earnings CAGR of close to around 25% on a consistent basis. And the kind of capex momentum that we have seen across multiple sectors is giving us this kind of a support. That's where these kinds of companies are trading at such a high and rich valuation. But any miss out would be something which could be really not looked at positively.
You know, Harshit, the fear is that maybe margins have peaked out for some of these companies because raw material pressures have started creeping in. Does that, put some pressure on the EPS expectations?
Yes, that do see some compression on the EPS side, but that would be passed on to as subsequent quarter comes up, given that the demand environment is extremely strong. So there could be subdued quarter for maybe fewer quarters, but post that there could be a recovery is what we have also seen in the last raw material cycle, which happened from 2022 to 2023.
Harshit, you said that obviously, 25% is the run rate that's going to be required to keep justifying these kind of valuations, right? So let's talk about where this 25% growth is going to be delivered from, which pockets, and from an investor standpoint, which are the areas that we should track more closely? I mean, I don't know, data centers, or should we look at power? Because even in power, there is so much of capacity that's being added. So should one be focused on power equipment companies as industrial automation? So which are the segments which are the key focus areas for you that you're tracking, and which are the companies that represent those sectors or that have a greater exposure to those sectors?
Yeah, so rightly you mentioned utilities has become a very important, both thermal as well as renewable, given that the manufacturing base is rising. So that has been predominantly the major sector. This is followed by data center as being another sector which is seeing an unprecedented momentum in terms of growth, both domestically as well as there is also a market on export side which is rising for renewables as well. So that is also propelling us growth for the sectors. And apart from that, if you have looked at oil and gas, the core economic sectors, which is oil and gas, metals, as well as Siemens, has also started to inch up their capex guidance, and that is also helping us believe that the growth is going to be there.
So in terms of your own projections, which companies in the ones that you cover are likely to post a 25% plus kind of a top line growth?
So within the companies which I cover, ABB looks to be on a very strong footing as far as the quarter is concerned, followed by Siemens. Siemens would be somewhere close to around 18% growth. Thermax would be something close to 15%, as well as cable and wire companies looks to be at a 20% kind of a growth. Given that Q1 is generally a very soft quarter as far as capital goods is concerned, second half is where the major growth comes up as far as the sector is concerned.
Actually, I was asking more from a longer term because you spoke about 25% over the next 5 years. So which of these companies, Q1 aside, can report this kind of robust, consistent growth?
So within the companies which I cover, it would be Siemens, KS International, KI Industries, Thermax are the companies which I would prefer and which would see a consistent growth of 25%, given that they are in a super cycle of industrial and their product portfolio is very much aligned to what the power requirement is, towards how the changes which are happening on the power side, moving more towards non-fossil environment as well.
Siemens, KEC, KEI and Thermax, right? These are the 4 companies. And these are your top picks?
Yes.
Okay. Thank you, Harshit, for the conversation today. We will slip into a very short break. On the other side, we bring you excerpts from our conversation with the management of Bank of Maharashtra.